Bismillahirrahmanirrahim. So this is officially the first lecture. Actually, we had first one lecture, but it was general introduction. So we covered 12 chapters of the modern monetary theory text in last semester. I'm going to start with chapter 13. In this chapter, we describe the basic issues of monetary and fiscal policy. This is what you will need if you work in the finance ministry or if you work in the State Bank of Pakistan. This is what will tell you what are the things that these people do. Always it is of importance to understand not only what the system is, but why the system is. And that's more difficult. The way the system works today has evolved, and especially the central bank is something which has changed its functions over time quite a bit. So just understanding what it is not sufficient. You have to understand why central banks are like what they are. But anyway, that might take some time. Today we'll just try to describe how the system works today. But you should always keep in mind that this is not given. It's not like biology where a tree grows because that's the way it is. But this is a artificially designed system which has defects and advantages and keeps changing. So, interestingly, even in this lecture, we will not go into very great depth, but there are a number of issues which are vastly misunderstood. People in the Treasury and people in the central bank do not really understand any the observed things. There will be complete agreement on what we described, but the meaning of these things, there is some disagreement and some misunderstanding. All right, so let's go into this. All right, so this is just copied from the chapter. We want to understand how the Treasury is basically the name for the finance ministry, and central bank is the State Bank of Pakistan. What is liquidity management? What is it that the central bank does? And what is fiscal policy? And what is the role of the taxation system? And basically, one of the key things that we want to explain here is that, contrary to what everyone in the Ministry of Finance believes, the object of taxation is not to raise money to pay for what the government is spending. Rather, it serves entirely different functions. But unfortunately, this is not understood by many people. Even there was a statement by somebody about some province or some leader, I don't remember exactly, that I have saved so much money by fighting a case against the Central Board of Revenue and getting our things tax-free. Now, if one government organization reduces its taxes, it is a saving for that organization, but there is no saving for the government, because basically the money that is being paid for tax belongs to the government, whether it's in the Central Board of Revenue or whether it's in some other department. So this is something that is not understood at all. And the fourth point is that the There's the issue of to what extent do we have sovereignty in terms of the domestic currency. This means that are we free to issue currencies to whatever extent we like, according to the requirements of the system or not. So if you have something like an European Union where everybody has euros, then there is zero sovereignty because they have no independence at all. In general, there is something which is called the trilemma of monetary policy, that the amount of money that we need for the domestic economy is not the amount of money that we need for foreign trade. So these two requirements can sometimes conflict, and so if you try to match the needs of the domestic economy, you might do badly with respect to foreign trade, and if you try to do good on foreign trade, you might do badly for the domestic economy. So that's something that's... So how much independence do we have? That's one of the key questions that is going to be discussed in this chapter. So what do central banks do? Well, it is widely understood that central banks print money, and to some extent this is true. They control the money supply. But actually the picture is quite a bit more complicated than that. For one thing, central banks do not really have control of the money supply. In fact, if you look at the early textbooks of economics, I don't even know what they say these days, but generally speaking, it is thought that the high-powered money is created by the central bank, and then there is a money multiplier, and you apply the money multiplier to the high-powered money, and you get the total money in the economy. And so by controlling the money supply, high-powered money supply, the central banks control the money supply in the economy. This is completely false. It doesn't work like that. The central bank does create high-powered money, but the private banks have the so-called multiplier doesn't really exist. The private banks can create as much money as they like, and so the total money stock is not in control of the central bank. And for a while, monetary policy was about controlling the money stock, but then once this was understood, central banks stopped trying to control the money supply, and now basically they control the interest rate, which in fact they can do, as we will see. So one of the things that the central bank does is what's called open market operations, which we will see later. So that's done on a day-to-day basis. Every day open market operations are done, and the goal of the open market operations is to control the interest rate to be in line with the policy rate, which is determined in the policy decisions. But the policy rate, as we will see, is an indicator. It is not forced upon the market directly. It is forced indirectly by other decisions which the central bank does to try to make sure that the actual rate in the market is close to the policy rate. So it's a control variable. According to what the central bank does, one of the things that the central bank does is to make sure that the banking system is stable. So it regulates the banks, the private banks, to make sure that they are not making risky loans, and generally they are in good health in terms of not having too many defaulting loans. But basically, as you are aware, the government deficit to some extent depends on the central bank, in the sense that the central bank makes loans to the government and also borrows money from private banks on behalf of the government. So many things which happen in the economy depend on what the central bank does, and so it is responsible to the parliament and to the government for the outcomes. Not too long ago, when there was a sharp decline in the rupee, then there was a argument between the central bank and even the Prime Minister said that he was not aware that this was going to take place, and the Governor of State Bank was called to question that why did you allow this to happen, and so on. So day-to-day management is the job of the central bank, and nobody can really interfere with it because it's too close to micro-detailed changes from hour to hour. But they are responsible to the government for outcomes, and they can be called to task. They are supposed to make sure that the economy is stable and that the exchange rates are stable, and basically the value of money is stable. The bank is created by laws and it has subject to laws, so it is not really all that independent. So it's independent at the micro level, but it is dependent because it is controlled and regulated. There is a general assumption that the central bank should be free and should not be should be independent of the Treasury. This is questionable, and there are reasons for this. Why this is independence of central bank is considered as a requirement, as in for good for operations, and we will get into that. But it's not really true. The central banks are not really independent and cannot really be independent. Monetary and fiscal policy have to be coordinated, and fiscal policy is determined by the Treasury or the Finance Ministry. So coordination means that they cannot act independently. So what are the goals of central banks? Well, basically the primary goal is to maintain stable prices. That is, the value of money should be stable. So central bank is in charge of money, and it should make sure that the money is stable. So, for example, it is the policy in USA and UK is that actually in US the central bank, or the what they call Federal Reserve, Fed, has currently the target that it should keep the inflation around 2%, and in the UK and Australia they have similar targets to keep the inflation rate low. Similarly, in Pakistan the inflation target is 6%. So why should it maintain stable prices? Well, it's very important for the private sector to have stability of prices, because in order to make plans for the future they need to know the inflation rate. If the inflation rate is not very predictable, then it's very hard for private sector firms to make plans, and this causes disruption and interference in GNP per capita, for example. In general, at the State Bank of Pakistan also, and in most banks, the goals of the central bank are written to be that it should maintain full employment as well as keep inflation low. However, in the past there has been a move towards inflation targeting and abandoning the goal of full employment. Even the State Bank of Pakistan has said things about how we will move to an inflation targeting regime. So now the idea of employment and inflation comes from Keynesian theory, where the Keynesian theory says that if the money is in excess of the amount required, then there will be inflation, and if the monetary growth rate is less than the amount required, then there will be unemployment. So this basic Keynesian theory says that the central bank has to keep the monetary growth at exactly the right rate, which will keep inflation low and it will keep employment high. And so that's what the theory comes from. But it seems that in order to achieve high employment, right level of monetary growth is not sufficient, and the tools that the central bank has are too crude to handle the employment problem. Although this is one part of the picture, but a lot more is needed to get to full employment. So the central bank by itself cannot achieve full employment. This doesn't mean that monetary policy does not affect employment. It does have a big effect, but getting to full employment is not the job of the central bank alone. So as we have already discussed, the central bank is not too independent. It has rules and regulations. So if the private banks make a loan, then they need reserves to back up that loan, and then they can go and ask for reserves, and the central bank is required to provide them with the reserves. Also, the Treasury or the Foreign Finance Ministry can say that the government needs 1 billion, and so the central bank may be forced to make loans. It is to the Treasury to finance the spending of the government. The policy that the central bank makes is also to manage the issues that the government is having. So it is not independent in the sense of it can do whatever it likes. The independence is used to make sure that the dollar exchange rate is stable and many other deficit doesn't have a bad effect on the economy and so on. Inflation doesn't go out of control and so on. So because the central bank has to create favorable outcomes and it has to manage things according to the needs of the economy, it is not independent in that sense. So what do central banks do in a very particular, very specific rate? The central banks set the overnight discount rate. In Pakistan, this is called the money market overnight repo rate. So every 2 months there is a meeting of the Monetary Policy Committee, and they set the rate. At the last meeting, which was on January 26th or something, or 27th, I don't remember exactly, the rate was changed from 10% to 10.25%. So that was the decision of the central bank. That was the policy decision. But what exactly did that do? This is something that requires deeper understanding. It doesn't really, the policy rate is not actually a rate in the market as such. I've written here that the private banks can borrow overnight from central bank, but this is not really true. Actually, what I have written is not really true. That's not actually how it happens. It's the lender of the last resort. Technically, if there are no other sources to borrow, the private banks might be able to borrow from the central bank at this rate. This doesn't really happen like that. This is a theoretical statement and not some reality of what happens. The Kaibor is the more operant rate in the market. If the bank is short of money, and why that happens we will discuss later, then it will go and try to borrow this money from other banks, and the rate that is relevant when you go to borrow from other banks is the Kaibor, the Karachi Interbank borrowing rate. Now, the central bank acts to keep the Kaibor close to the MMOR. So that's how actually it works. And how it does that also we will discuss later. So basically, All right. So private banks have reserves which are kept in cash. Well, cash is now just a metaphorical expression. There is no real cash involved. It's just a convenient name. So banks have some reserves. Every bank is required to keep some reserves with the central bank. And so those reserves are basically just electronic entries in the accounts of banks. There is no cash. The banks also have reserves with them, their own selves, to handle their day-to-day operations. And these are also partially electronic entries and partially in cash. The banks need reserves for some purpose that we will discuss. So actually the total portfolio of the bank is the amount of loans which it has made, which could be very large. So for example, the bank might have 1 million rupees in loans which it has made to various parties, but reserves it might have only 1 lakhs or something like that. So the reserves, depending on the requirements which we will discuss, the private banking system can have excess reserves or it can have insufficient reserves. If there are excess reserves, then the banks will want to lend these reserves to others, and when they try to lend to others, this is an excess supply situation. This will cause the price of money to go down, the KIBOR to go down. Now what the central bank does in order to prevent the KIBOR from going down below the policy rate is that once it starts going down sufficiently, then the bank will start buying these reserves. Actually it doesn't really buy reserves. What it does is it sells treasury bills in such a way that the rate doesn't go down. So once the central banks offer the money that, okay, I want to lend this money, and there are no takers, or the takers are offering too low a price, then the central bank has these treasury bills which it will sell at a price which will make the yield equal to the money market overnight rate or close to it. So remember that the treasury bill has a face value, but the value at which you sell it will change the yield, and so you can make sure that the price of the sale is such that the yield is actually equal to the money market or the KIBOR. So if there is excess reserves, then the central banks these are called money market operations. Basically these are called mop-up operations, because basically you are taking this excess liquidity and you are mopping it up so that it doesn't drive the rate slow. So how do the private banks get reserves? They can get them by borrowing from the central bank, by selling financial assets like treasury bills, by when people repay their loans to them, then they acquire reserves. If they purchase financial assets like treasury bills, that reduces their reserves. And the central banks basically manage the reserves of the private banks to ensure that the KIBOR is near the policy level. So how does the banking system work? Well, the central bank must supply reserves when the banks need them. So this is not in its control. So this is one of the key things that we must understand, that people think, what is written in textbooks is that the amount of high-powered money is in the control of the central bank. But this is not true, because what happens is that the private banks make loans. Like if I have made a loan of 3 million rupees to somebody, now the central bank requires that I should have reserves to back this, but I may have made this loan without having any reserves. So now what I will do is I will borrow the required 3% of this from the central bank or on Kaibor market. That will give me the reserves, and that will satisfy the liquidity requirement. So the standard, so when I try to borrow reserves, then if there are reserves in the system, that's fine. If there are not, then the central bank will create the reserves, and so the central bank does not have discretion in this matter. It doesn't create the amount of reserves according to its policy. It creates according to the demands of the time. So that means that basically money supply is not really directly in control of the central bank. However, the rate at which you lend the money, this is discretion. This is in control of the central bank. So the overnight rate is in control. The long run rate is a different matter, and that is actually considered by most economists to be very powerful instrument, but it is not directly in control of the central bank, although the short run rate does have some impact on it. So the standard theory that is taught in books, and that is in the minds of students and in the minds of bankers, is that we loan money. So money is actually reserves. Private banks do not loan reserves. Reserves are kept in the banking system or given to people as cash. When they make loans, they create electronic entries, and these are a separate. You can say that they loan credit. So basically, if you look at Werner's theory, Richard Werner, it's the quantity theory of credit. You see, when what you have in the circulating in the economy is money, which you can think of as high-powered reserve, and credit, which is created by banks. So these two different things, and if we keep them separate, then less confusion arises in understanding the money supply. So the banks create credit, and they back this credit up by reserves according to the law. So now there are two big players in the market. There are the private banks, but then there is also the central bank, and then there is also the finance ministry. These are three different players. If the government wants to borrow money, like if the government has to spend money and it doesn't have the money to spend, it can just borrow money from the central bank. And basically the government is always borrowing a large amount of money, and it can borrow from the central bank or it can borrow from the private banks. How it does this is also very important to understand. In the first place, basically the Treasury has an account at the central bank. So the government of Pakistan has an account, and this account can contain, for example, 1 trillion rupees. I think it's something like that this currently. So it can write a check on this account. So if I write a check, the government writes a check in fact, we received a check for some amount, large amount of money. Okay, here's some money, you have this money to run PIDE with. So we have this money, we put it in the bank, we put it in our bank, which is our bank, can be HBL, for example. Yeah. So now this money comes into the bank, and basically what the central bank does is it creates a credit for HBL within HBL account at the central bank. So the government wrote a check to PIDE for 50 million rupees. PIDE deposited this this check into HBL account of PIDE. So when it does that, then the HBL presents this bank to the central bank that I have a check, and technically what happens is that the government, the central bank takes 50 million from the government account and puts it into the account of HBL, which is also at the central bank. Now, one of these transactions. Now, when the central bank puts 50 million into the account of HBL at central bank, it just writes 50 million plus in their account. It also does the offsetting transaction, but this transaction is just an illusion. It doesn't need to do anything to the government account. This is where the mistake is made, that people think that the government has to have money in order to spend it. Technically, the central bank need not do anything at this point. It can just say, okay, the government wrote a check, so HBL has the money. The government amount of money is just entry. It doesn't have any real existence. This number doesn't have any real meaning. But it sort of keeps track of what the government is doing. So one way to keep track is to deduct the amount of money. We will get better understanding of this later. Alright, so now let's think about what would happen if you were at the Treasury. The people at the Treasury don't think, what I have explained, they don't understand this. They think that we have to have money to spend it. This is just rules of the game, like, you make rules that, okay, if you hit the ball outside this circle, we will count this as a 6. It's just a rule that we have made. It is not something which is a constraint imposed by the nature. Alright, so basically how the people at the Treasury think, they don't think like this at all. They say that we have an account, this is the amount of money we have to spend this money. If we are asked to spend more than what we have, then we must borrow this money. When we borrow money, there are many things that you can do. So basically, Treasury tries to decide what are the projects we will spend on, how much we will spend on what project, and how we will raise revenue to pay for what we spend. These are the standard questions that the finance ministry asks, even though these questions are the wrong questions. These are not the questions which Treasury should be asking. Alright, so the mini budget, for example, which was made, was that, okay, there is a general budget which is already made, the government is running. Now in a mini budget you said, okay, we will, you say, okay, there are certain extra projects that we want to spend on, which were not planned for by the last government, so here is what we will be spending. And then, okay, since you are going to spend money, where are you going to get the money? So you put down that we are going to raise these taxes and we are going to sell this corporation and raise revenue, etc. So a mini budget is something like that. It's supplementary to the regular budget. So these are the questions which the mini budget would address. Alright, so how does the money flow through the economy? Basically, the job of the Treasury, the finance ministry, is to make money available to the government for spending. The government spends the money. When the government spends the money, then money actually comes into existence. This is because it is sovereign money. Before that, it is just entries in accounts. The central bank can write however much money. In fact, this was seriously proposed that the government has a huge debt in the USA. So they said, let's just introduce a coin for $1 trillion and put it into the bank, and that will be. So the central bank can do that. Actually, people who studied the law, they said that yes, it's possible. For various reasons, they didn't do it. But if people are talking about how the government debt is going too high, then the central bank can say, okay, I have coined a money. This money is worth $1 trillion. I put it into the account of the government, and now the government deficit is gone, because the Treasury is authorized to print money, and they can print money, so they can. So now money comes into existence via government spending. Then this money is circulating in the economy. Taxation collects this money. So now basically reduces the amount of money that is running around in the economy. So the standard picture which is in the minds of the Treasury is that, so when the Treasury, when the Central Board of Revenue imposes taxes, then it takes this money and deposits it into various accounts, and then these accounts put it back into the central bank, and the central bank puts it back into the government account. So now the picture in the minds of the Treasury is that we impose taxes, we create that gives us the money, and then we spend it. But actually the sequence is quite the opposite. Money comes into existence by spending, and then that creates the money which you can tax. So one of the lessons from this is governments do not and should not balance budgets. The government spending has, I mean, this is sort of an artificial and fake constraint based on the artificial. You see, the government need not keep any account. The government can just spend. The fact that the government has an account at the central bank is completely irrelevant. You could get rid of that account. It is just a number. Government does not. Government can just write checks, and when it writes checks, the central bank will credit whoever it gives the check to. The government, because the government is the owner of money, just like, you see, the US is the owner of dollars. They can just print dollars and give them to us. They don't ask that which account the dollar is coming from, because they can just print them. Just like that, the government is authorized to print money, and so it can just print money and give it to us. So, how much money the government should spend? This is definitely a very important question, but it has nothing to do with how much taxes it can raise. So basically money is a unit account in this situation, and people think, everybody thinks, people at the Treasury think, Secretary Finance thinks that we need to have money in order to spend it, and so if the government is going to finance a lot of projects, then we need to raise a lot of taxes in order to be able to finance these projects. This is completely wrong and misleading. So as this is written in the textbook, that if the government raises money by taxation, and it can just burn up those notes, and it can print new notes, and the new notes that it prints need not have any relationship to the old notes that it. So basically, just like the central bank does mop-up operations in order to keep the interest rate high, so taxation is also a mop-up operation to keep the quantity of money in the hands of the public low, and this may be required for some reason. So this idea of balanced budgets, which is also called austerity, is known to cause unemployment because it ties the hands of the government unnecessarily. Now this doesn't mean that the government can print as much money as it likes. Printing money has effects, but you have to calculate what the effects are and what is the right level of money to print. Now, everybody else other than the government, they do have to balance budgets. If you have a firm, and if you are going to purchase some inputs, or you're going to pay your laborers, you have to pay them in money. You have to pay them in cash. You cannot print money to do so. So the amount that you earn should be roughly in proportion to the amount that you spend. If that's not so, you will go out of business. Local governments like provinces here, Punjab, and they get money from the government. They are not authorized to print money, So they have to balance their budgets. So everybody else must balance budgets, but the government does not have to balance budgets and does not. Look at the budget of the US, it keeps going higher and higher in deficit by trillions of dollars every year without any serious consequences. And same for Pakistan, same for all governments. So basically, one important insight of the modern monetary theory is that there are different sectors of the economy. Basically, in the textbook, they don't differentiate between financial and real sector, but it would be useful to do that. The real sector of the economy is the firms which are producing, and service sector, university. Then there is the financial sector, which is basically banks. So now the banks actually get to create money. So if you look at the real sector and think about the amount of money that is circulating in it, then that money is fixed, yani it cannot be created or destroyed. But the government can create money. So the government can run surpluses, that is, its budget is not balanced. So if the government spends into the real sector a lot of money and taxes less, then the real sector will have some surplus. If the government spends and the money comes into existence by the spending of the government, then if it taxes everything, which is balanced budgets, then the surplus of the real sector will be exactly zero. I mean, they may have money from previous periods, but nobody in the real sector can make any profits if the government does not run a deficit. This sectoral balance equation is very important, that if the government has a deficit, only then the private sector can make a surplus. And there are two major parties in the private sector. There's the firms which are trying to make profits. They will not make profits unless the government has a deficit. And the individuals or the households, they are trying to make savings. Again, they cannot make savings unless the government runs a surplus. So the government deficit is equal to the private sector surplus, which explains why a balanced budget is a bad idea and wrong policy. I have separated the finance sector. It's not done in the text, and I won't do it here either. But basically, because the financial sector also can generate money, it's useful to treat the three sectors separately. But I'm not doing so right now because we are studying that. So the coordination of monetary and fiscal policy. Well, what is fiscal policy? Fiscal policy is basically the government budget. How much tax it's going to collect and how much it is going to spend. That is your fiscal policy. So basically what Keynes said was that if you are in a depression, then you should run an expansionary fiscal policy. You should try to spend more on projects so that the depression means that the private sector firms are hurting and the private sector households are not making savings. So basically, if the government spends more, runs a bigger deficit, the private sector surplus will be higher. So now the artificial rules of the game, we come back to the government has an account, and so now in order to keep the budget balance, if the government spend, you see, now they need to raise money in order to make the spend, to make the expenditure. They have to keep that budget balance. This is a completely artificial rule. And now, why is this rule enforced? Well, there is a reason for this that is given, and that makes some sense. And that is that if we allow the politicians to know that they can print money arbitrarily, then there would be no way to control the government expenditure. So we have to deceive them into thinking that they should balance budgets so that they don't go out of control. This is one argument that is given, and maybe it is valid, I don't know. So now if we say, okay, the government, instead of, you see, what I am saying is that government does not need to have any account, doesn't need to borrow anything from anybody, doesn't need actually to even tax anybody. If the government needs to spend, they just write a check. Now the question is how many checks they should write, and can they finance anything they like? Well, no, it depends on what they finance. But so the artificial rules are that the government cannot do this. The government, when government writes a check, it has to have money in its account. So now suppose that the government wants to write a check, as it happens frequently. The government wants to spend 2 trillion rupees, and the government only has 1 trillion rupees in the bank. So what can it do? There are many things it can do. It can borrow from the state bank. It can say, okay, state bank. So if it does so, then the state bank will acquire a liability. It makes a loan to the government, and now it has an asset, which is the loan which will be repaid to it, and the government has a debt. Or it can sell bonds to the private sector, and this is what often happens. So basically the government sells T-bills, 3-month Treasury bills, which are sold to the banks, and so the banks give money to the government, which the government created in the first place. So basically, again, this is a mop-up operation, that the government is reducing the money which the private sector is holding. It is not raising revenue, because the revenue is spent without any counterpart backing. So it can sell bonds to the public, it can sell bonds to the central bank. Okay. All right, so fiscal policy just means the government spending of money. That's the correct way to stand it. Taxation is also part of fiscal policy, but basically the Treasury writes checks which are deposited in private banks. The private banks deposit the checks in central bank. The reserves of the private banks increase, and that's it. The next operation which takes place is an artificial and unnecessary. What central bank does is it takes the check and deducts that from the amount of money that the government is supposed to have, even though the government has infinite money. All right, so this is some basic bookkeeping. When you look at the government account, see, when you look at the government account, then you get into trouble, because government has reserves, it has some credits, it has liabilities, which is interest on past debt, and it has to make payments, salaries, expenditures. And so this account of the government is matched by a counterpart account of the state bank. So when the state bank lends to the government, then it acquires. State bank is not a ordinary bank, but it keeps accounts. The state bank has accounts of private banks, it also has an account of the government, and so it also has its own assets. So it has loans to the government, it has treasury bills which are created by the Treasury and given to the state bank to sell, to raise revenue for the government. All of this is artificial, and much of this could be simplified. So what happens next after the? So basically, I'm saying, if you ignore all that government account business, which is confusing and complicated, and you say, okay, the government spends some money, what happens next? Well, the government spends a lot of money flows into the private sector. Private banks get, the first step that happens, because it writes checks, is the private banks get a lot of reserves. So they have excess reserves. On the basis of this reserves, now they can extend a lot of credit. So suppose that the government spent 1 million rupees. Now all of the banks in the economy have 1 million rupees, and now they can give credit of 10 million rupees. So they are going around with this cash, and they want to Actually, this is a misleading. They now have the capability to create credit of 10 million. So they want to lend this 10 million that they can, and they can lend this to the private sector if they can get sufficiently high interest rates to justify the loan. So if there are loan opportunities, they will use them. But if they try to lend to each other in the interbank market, because they have excess reserves, they are not required to keep that many reserves, then that will drive the interest rate down. So what happens next is that as they try to get these loans, the T-bills, as the interest rate starts going down, the central bank sells T-bills to the private banks so that the rate remains at the level that it is that the policy rate. So this is called a mop-up operation. So they mop up this money by selling T-bills, acquiring cash, and in the meanwhile the private banks get the T-bills instead of cash. So this means that the monetary policy has to be coordinated with the fiscal. When the fiscal policy creates excess liquidity, then the central bank has to mop up the excess liquidity in order to keep the interest rate at the policy target level. So it is said that this is the government budget constraint. The government has its own spending, which is G, which is spending on salaries and expenditures and purchases, and then the past loans that it has taken, it has to pay interest on. So R times the bonds that it has, treasury bonds that it has. This is the outstanding treasury bond. It has to make those payments. These are the expenses of the government. And then the revenue of the government is taxes. So this is the total budget of the government, the amount it spends on salaries and expenditures, the amount it pays on interest on past loans that it has taken, which were completely unnecessary. It did not need to take any loans. And then the amount of tax it collects as revenue. And this has to match basically the amount of money that is created by the state bank and the amount of increase in bonds. I mean, if either it gets a loan from the central bank, which is basically pure money creation, high-powered money, or it can get loan from private banks by selling them T-bills. So these are the two ways that it can raise budget. So it is thought by the Ministry of Finance that this is a budget constraint. That is the amount of money you print plus the amount of treasury bonds you sell plus the taxes, if you want to put the tax on the other side, is your revenue, and then your spending must be kept within this revenue. But actually both the amount of money you create and the amount of bond you sell is exactly, and this is an accounting identity. This has to hold true by definition. So if the government goes out and spends money, then it will exactly match the amount of money that is created by this spending. And if it spends, if it sells bonds, that will give it the so this is just a accounting identity. It's not a constraint on government spending. It's not that things happen first and later, that first the central bank prints money and then the treasury collects taxes and then the central bank sells bonds, and all of this money is collected and handed over to the government that, look, here's your money and now you go and spend it. That's not how it happens. But although this is how people think it happens. So basically the government can freely print money without any constraints, provided that the currency is not tied to gold. If the currency is tied to gold, then you have to have gold backing for your currency. Even then, it used to happen that the government would print, the government tried to keep a certain fraction of reserves, like 20%. So if the government prints 20 rupees, it should have 1 rupee of gold. But this could go up and down, and the government in times of need could print 30 times and so on. But the problem was that in such situations, as long as you see, if you have gold banking and you don't have any foreign trade, then the gold is just an illusion. And in fact, that's what happened in the US. They said that, okay, the dollar is worth so much gold, ounces of gold, but nobody can get it. You cannot cash your dollars for gold at the central bank. So it's just that, then it just becomes a meaningless number. So as long as you have sovereign currency, the government is free to print. They could change the ratio, and they did. That, okay, yesterday the dollar is worth so many ounces of gold, but today it's worth half of that. As long as actual dollar to gold trades is not allowed, this will not cause any difficulty. Now, what happens is that if you have international trade, then people, if you pump a lot of money into the economy, people will use that money to buy foreign goods. If the foreign exchange market is free, this is a very crucial issue. If you have no capital controls, then you can use rupees to buy dollars freely. Then people will import goods, and if people start importing goods, then rupees will accumulate in the hands of foreigners. Now, we don't have sovereignty over the foreigners, so they will do something with these rupees. Typically what would happen is that they would take these rupees and either they would purchase our goods, so that would be fine if our exports are matched to imports at the current prices, then there is no problem. But if people go and try to cash their rupees at the central bank for gold, then you would run into a serious problem. That's what used to happen in the gold standard. Now, if you don't have gold standard, then when lots of people get rupees, then they try to buy our Pakistani goods. What will happen then is that if there is an excess of rupees, the value of our goods will go up in rupee terms, and basically the exchange rate, the rupee will be devalued. It will be because we are importing a lot of goods and our imports are few, so the value of the rupee has to go down to prevent us from importing so much, and to prevent to increase our exports. Yes, our goods will become cheaper, so it will cause our exports to increase and our imports to decrease. So that's the standard equilibrating mechanism. So basically, if the government has promised to maintain the exchange rate at a certain level, which is what has been happening, then we run into the problem that we see in the economy over the past, in fact, 30-40 years. The government has maintained an overvalued rupee. So what happens is that when we import currency, then the value of the rupee should go down. So the people try to cash the rupee. People want to sell rupees and buy dollars, because the dollar goods are cheap and rupee goods are expensive, because the equilibrium is not there. So when they sell rupees and try to buy dollars, the value of the dollar would go up because there is a lot of demand for the dollar. But now suppose that the state bank is trying to maintain dollars, and this is what happens. So the state is trying to maintain the value of the rupee at 105. So if lots of people are buying dollars at this price, then if the price goes down, and if the dollar becomes more expensive, then the demand for dollars will be curtailed. But suppose that the we don't want the price to go down. Then what will happen is that the free market supply of dollars will not be enough to support the demand for dollars. So that then the State Bank has to supply the additional dollars from its own reserves, and that's how the foreign exchange reserves of the State Bank decline. And if there is a huge demand for dollars, and this demand is backed by the rich and the powerful, then the State Bank is forced to try to borrow foreign reserves in order to keep the rupee price stable. And it has only two options. Either it has a lot of reserves which it can sell, so it's selling cheap dollars to the public because nobody else will sell, because if you or it just allows the rupee price of dollar to increase. So these are the only two options. So what happened recently was that the reserves were at near zero, and so the dollar price could not be maintained, so the State Bank allowed the price to jump up. Now what the MMT recommendation is that there should be completely free floating. There should be no the government should not support the dollar at all. In that case, foreign exchange reserves are completely unnecessary because the State Bank does not interfere with the price of the dollar. So why doesn't this government and why doesn't any other government not do that? Well, basically, part of this is called fear of floating. But there is a fear of floating, but there is a reason for the fear of floating. Basically, what happens is that we have an economy. The economy is run by these firms. The firms have made their calculations that we have some inputs that we are going to buy, and this is the products we are going to produce, and this is what we are going to sell. So this business is going to be profitable at a certain configuration of prices. That okay, my inputs cost, this inputs cost 10 rupees, this costs 50 rupees, my product cost, my labor costs are 40 rupees, and so my unit cost is 100 rupees. So if I sell it for 200, I'll make a profit of 100. But suppose now that your input, which was costing 60 rupees, doubles to 120 rupees. Now your profits go down quite a bit. And if your labor costs also go up, then suddenly you start making losses. So you have planned out your business according to a certain configuration of prices. If this configuration of prices is very erratic, then what was a profitable deal could become a loss-making deal. So generally, within an economy, these things keep happening. Some business collapses and new businesses come up as the price configuration changes. But if this happens too fast, it's a serious cause of problem. Also, if there is something which is, this is what is called the Dutch disease, if there is a general overvaluation of rupee, as has happened in Pakistan then what happens is that you see imports have been systematically undervalued, and rupee has been systematically overvalued. So that's why we can buy imported milk from Australia, but our milk does not sell even though we have a huge amount, because our milk is expensive, because rupee is expensive and Australian dollar is cheap. So it makes no sense for us to be able to buy milk from Australia except when the and how is this financed? It's financed by the State Bank. The State Bank gives you suppose that it should be 1 rupee for $1, but the State Banks and suppose that all prices are equal in Australia, but State Bank says that if you buy $1, I will give you 10 cents. So now everything is equal, but now if I buy Australian milk, I can buy it for 90 paisa, and if I buy domestic milk, it will cost me 1 rupee. So this is what happens. This is what's called Dutch disease. Now a whole cluster of industries come up on the idea that this is the pattern of prices. Now if you change the prices, it's going to be very painful, because the whole industries will collapse. new industries which would have come in, suppose that the imports had been very expensive, then people would have devised different ways to produce goods, because those ways which are based on importing would not have been profitable. So they would have used domestic, even we are importing palm seeds from Malaysia, when you can grow any kind of number of palms you like. We have vast amount of beaches, and we can grow any amount, but it's much more expensive to grow our own palms, and it's much cheaper to buy palm seeds from Malaysia. So basically this is what's called Dutch disease, and that's what has happened in Pakistan. Alright, so spend first, tax later. This is the MMT sequence. So the point here is that if we support dollars, then all of these problems will happen. We will need foreign reserves from time to time, because we are continuously pumping money into the market. We will continuously need to be getting loans in dollars, and then we have serious. Our exports will not be competitive, and over the past 2 or 3 decades, we have fallen behind in exports by massive amounts relative to Bangladesh, India, China. All of these were behind us in exports at some point, and they overtook, and they have been, the rate of growth of exports has been much higher than that of Pakistan, and still is. So the point is that the modern monetary theory recommends that we should have freely floating exchange rates. This runs into the problem that the price of imports can be very erratic, and if so, that will cause the same problem. So this leads to 2 recommendations. One is that you should try to have a self-sufficient economy, so that, because domestic prices will not be dependent, will not be volatile relative of the and the other is that there are various ways to smooth out the import requirements, so that sudden errat, and actually firms do that. This can be done at state level, this can be done at private level. For example, you enter into a long-term contract with a firm that you're going to supply me this input at such and such price for such and such period of time, so that the erraticness does not affect. There are also more complicated things like forward contracts, etc., which can be used. So as long as you have free floating currencies, the government does not have a budget constraint. It can print as much money as it like. But if you are constrained to supporting the currency, as the government has been, then you do have a budget constraint, because if you print too much money, this will go into the economy. People will will try to buy dollars, and when they buy dollars, then they will there will be a strain on your foreign exchange reserves, because you are committed to supporting the currency, and so you will run into trouble. And this has been exactly the problem. This is why we have a budget problem in Pakistan, because we are trying to support if you allow the currency to appreciate, if you allow the dollar to appreciate, then the government does not need to worry about deficit spending. But this is something which very few people understand. Okay, I think we covered all of this idea that the MMT says that we spend first, and then this creates excess liquidity. Now, one purpose of taxation would be to prevent people from buying foreign goods. So you should tax those sectors where you should tax the rich who will buy imported goods, and not tax the poor who will not buy. So that's one way. And in general, any kind of tax which will that will help in terms of keeping the exchange rate stable. So that's one of the purposes of. So basically, what happens is that if government spends money without any constraint, then there's a huge amount of money that comes into the economy. There's a fixed amount of goods. So if you spend more, obviously you're going to have inflation. because there's a fixed amount of goods. The more money you have, the more the price of goods will be. So basically, then one thing that the government can do is to tax in order to mop up that money to reduce aggregate demand. So that's one of the purposes of taxation, to reduce aggregate demand so that inflation doesn't occur. So all of this was the Secretary of State in the USA, Rummel, in 1950, and he realized all of this in 1950, and he has written papers which are very insightful, and unfortunately these things are still not understood, even though it was. He said that today, because of the changes that have occurred in the financial system, taxes, basically the gold standard was there in 1914 to 18 before the World War, and it broke down between World War I and World War II, which World War II was 1942 to 1944. In the interwar period, all the countries tried to get back to the gold standard, but failed. And in fact, one of the reasons which is given for the World War II is the failure of the gold standard. Basically, what happened was that the Germans were forced to pay a huge amount of reparations. Keynes said that this will not work, and this will lead to Germany running out of money in 20 years, which was a pretty exact prediction. 1918, the World War I ended. 28, 38, 25 years, I think he said something like that. And then they will have, once they run out of money, they will have no choice but to go to war. So basically he predicted that he calculated that the amount of penalty you have imposed, they will not be able to pay for more than 20 years, and then they will go to war. So because the Germany had to pay a lot of money, they created the hyperinflation. And once you had the hyperinflation, then the German economy got delinked to the other economies, because now, see, in order to be able to trade with another country, you need to have some stable currency. And when the German currency became unstable, then it became impossible to trade. And once the trade ties are shut off, then war becomes much more easy, because you have nothing to gain, you have nothing to lose by war. Interestingly, I have provided a link to this in one of my lectures in the macro one. There was a episode between Pakistan and India some long time ago, I don't remember the dates anymore, where the currency of England was revalued, and so India devalued its currency to match, but Pakistan did not devalue its currency. So what happened was that the exchange rate between Pakistani rupee and Indian rupee suddenly shifted, and as a consequence, the trade between India and Pakistan became substantially reduced. And this may have been one of the reasons why there has been so much political tension and war, because we don't trade with each other, we have nothing to gain. You see, when you go to war, there's always one party which is gaining from peace, which is making a lot of money from trade, and one party which is gaining from war. So these two parties keep balance. But if you have nobody who is there is no trade, nobody who is gaining from having peaceful relations, then it is much more difficult to maintain peace. And so this is a very interesting episode. And once we broke, so this monetary policy has a lot to do with war. And in fact, the European Union was formed explicitly in the mind of the people that First we had World War I, then we had World War II, and basically, if you look at European history, for centuries, they have been fighting each other continuously. So they said that if we tie the countries together by strong bonds of trade, it will make it more difficult for the countries to go to war with each other. And more or less, this seems to have worked. So he says that basically after the end of the gold standard at World War II, currencies are no longer tied to gold, so we can print as much as we like. So taxes are no longer needed. We can just print whatever money is needed. So then how should we spend money? Well, the government should spend money to try to ensure that there is full employment. There is no budget constraint, and it should spend money to get prosperity in the country. And there are two key changes which he said that has occurred in post-war period. One is that there is no tied to gold, and the other is that the central banks have, in basically 1918, I think the Federal Reserve Bank was created. So they have gotten a lot of experience in managing the monetary system, so they can run the country's economy quite well. So should we eliminate taxes? No, there are some things that we need to do. One is to, but we should understand the purpose of taxation is not to raise revenue for the government. One is to stabilize the value of the dollar. If you have excess dollars and you have imports, then that will cause exchange rate problems. The other is to redistribute income. You take money away from the rich, give to the poor. Then you want to encourage fair, you want to put taxes on things which you want to discourage, which is called sin taxes, like cigarette, alcohol, luxury imports, etc. You don't want people to do that. And also, some taxes distribute the burden of public goods evenly. So, for example, if you have a gasoline tax, then there's the people who drive cars are taking a lot of benefit from the huge amount of investment in roads, so they should get to pay, as opposed to people who don't use cars. They should not pay as much. So taxes are collected equally from everybody, but some portions of the infrastructure are used more heavily by some people, so they should pay. And the infrastructure is a public good, so you can't charge prices for it. So you should use taxation policy to try to make this burden equitable. So these are some of the reasons for taxation given by Rummel. But he says that basically don't confuse the purpose of taxation. It's not about raising revenues to pay for government spending. We should try to keep taxes low as long as we want to achieve full employment. And the other objective which I mentioned, the stabilizing the foreign exchange, if you have free floating, then you don't have an objective. I don't think this is part of what Rummel said, but this is part of what modern monetary policy. The reason we quote Rummel here is that in 1950s this was understood, but there is a strong effort to suppress this knowledge exactly. So how can we maintain? We have to have, in order to apply this, you see currently Pakistan does not have a sovereign currency because we are supporting the exchange rate at an artificially high level, and therefore we have to worry about raising money to pay for our expenditures, because as long as you want to maintain your currency, you have to use currency for domestic use only. You should not make any promises to convert currency to any other object. You have to have free floating exchange rates. There is an alternative to this, which is to impose capital controls. And this has been done in the past. That if we say that rupees cannot be exchanged for dollars, then we can issue our currency to the extent we like, because there will be no leakages into foreign exchange. This has its own other set of problems, but we can maintain artificially. And these techniques were used by East Asian economies. So you can maintain dual exchange rates, and actually it's a helpful and valuable technique. So dual exchange rate means that some imports which we think are strategic and important, the industries which are allowed to import at a low exchange rate, they are supported, and other imports which are not helpful, we maintain a high exchange rate for those. If you have capital controls, you can do things like that, but there are some difficulties with those, mainly corruption. All right, so this is government spending and earning. We have already gone into this, and coordination, I have already discussed this. Basically, the government spending creates liquidity, and the central bank is required to destroy or mop up this liquidity in order to maintain the money supply. So there has to be coordination between Treasury and central bank. They cannot work independently. So government spending is basically the creation of money. That is, and government spending creates money. We sell bonds. The government sells bonds, and it's thought that the government is selling bonds to raise revenue to pay, but that's not really what is happening. So these are just explaining what the government does. So basically, the government, when spending creates high-powered money, we sell bonds to mop up high-powered money, not to raise revenue. The interest rate is set by the government. People think that when the government goes on the market and demands money, this leads to an increase in interest rate, but this is not the way things actually are. And so when the government sends bonds, this is part of your monetary policy. You are controlling it's not part of fiscal policy to raise revenue. Okay, so if the government does not control money, the overnight rate could fall to 0. Okay, so this I won't go into, but basically, why should we keep the discount rate at a certain level? This has a lot of different complex implications, and so we won't discuss that right now. All right, so now one of the things that because the government thinks that we need to finance our operations, so they sell bonds of varying maturities, so 3-month bonds and 9 months bonds and 10-year bonds, so that our financing costs are reduced. But this is based on a misunderstanding of the way the market works, and if you understand how it is, then you only need to sell short-term 3-month bonds, which is actually the current situation. So the private banks are required to maintain 3% in cash at the central bank overnight. Yani if you have a total liabilities of 100 million, then you need to keep 3 million in the central bank every night, and every 2 weeks your total amount should be averaging to 5%. In addition to this, you need to keep 19% in treasury bills and PIBs. And in addition to this, you're not required to, but you need to keep some money in your own banks to meet your day-to-day requirements. But this is not part of the requirement from the central bank. So there's some amount, like here's 24% or 24%, maybe 6% more. So maybe 30% of what you have loaned, you need to keep in terms of your requirements. So this is the amount that the banks like to keep. So every night they try to make sure that, if your liabilities are 100 million, try to make sure that you have 30 million in hand. If you have less than that, then you try to acquire this. And if there's shortage of liquidity, then what the central bank does is it does mop-up operation. It buys the T-bills that you have, and it gives you money in return so that your liquidity increases. And if there is excess liquidity in the market, if you have more than 30, then the central bank does mop-up operation, and it sells you T-bills in order to reduce this liquidity. Okay, we've discussed the open market operations, and so I think that's all for today. So I think today you understand more than most people who when I joined the Monetary Policy Committee,